Thanks very much. Thanks for inviting me, and good to be here. Just going to see if I can get my slides working first. Perfect. So to start off, I wanted to give you guys a little bit of a view on what Finance Watch is, how it was set up, and what we do in Brussels. So we're a non-profit organization. Often we describe ourselves as a civil society organization. We were founded just after the financial crisis by the commissioner at the time, Michel Barnier. You've heard about him more recently in other new roles, and also by MEPs, a group of MEPs working in the Econ Committee, who saw the need for an organization that could give a civil society perspective, a public interest perspective on financial regulation as this regulation was being created after the financial crisis. So at that time and still now, many of our colleagues are ex-financial industry professionals, so who've worked in derivatives trading, auditing, risk management in banks, asset managers, insurers, etc. And these experts allow us to really challenge financial regulation, understand the industry perspective on it, why they're saying the things they do, but if necessary, challenge it and bring a public interest perspective. We also were created by members, and that membership has expanded over time. Why? Because it gives both us legitimacy and also input and feedback on how citizens, consumers, and the people we want to represent and whose interests we're trying to represent in Brussels, it gives us information on what their views are, what's important to them, and that's mainly through organizations, so other organizations which include trade unions, consumer organizations, but also Chamber of Commerce, which in one country. So lots of different organizations and individual members, including academics, who give us that input, who help us to form our positions and also give us a view on what's happening across Europe in the 20 countries where we have represented members. We do a number of different activities, but really our goal is to influence, ultimate goal is to influence regulation in the public interest and to have an outcome from financial regulation, which means that the financial system is serving society. So that starts for us with research, so understanding what policy positions might need to change, what might need to change as concrete amendments to financial regulation, splitting them into the 4 areas for our purposes, but also in Brussels often for similar sort of areas, even if they would be called slightly differently: stability, people, democracy, planet. We'll get into those thematic areas a little bit later on. Taking those policy positions to policymakers, so understanding the legislative process, where it's important to contribute, who the actors we need to speak to are, also providing that expertise to our members. A lot of our members are not necessarily experts on financial regulation. They may have an interest in a specific topic or part which is relatively connected, but might not have expertise on the technical details. So we can also act as a hub for them, and a hub of expertise on financial regulation and the legislative process. But as a small NGO, especially faced with quite rich, powerful industry with a lot of resources, we do need to use both our members but also other NGOs to collaborate, to kind of have the reach, to have enough capacity to work on the different topics that we need to challenge sometimes the financial industry. Even if challenging the industry or challenging policymakers is not our first goal, it's really about bringing that in public interest position. If the industry is bringing it, we're happy to agree with them. If not, we might challenge it. One of the other roles that we have, and one of the other key things we try to do, we also, part of our financing from the European Commission is for that, is to explain the way the financial system works, but particularly how financial regulation in Brussels works to citizens and to the public. So to kind of hold sometimes seminars, sometimes come to groups like yours, although I think you guys are very well informed compared to some of the groups we speak to, but to come to different groups and also try to either debate or increase people's knowledge on how the financial system works. Okay, so I think I've covered a couple of slides, which is great. So a couple of different ways that we try to act, and some of the reasons we're in Brussels and we target advocacy, or make a difference in our advocacy, is really through the first thing I mentioned, through the fact that we have ex-finance professionals. This gives us credibility when we talk to policymakers in Brussels. They tend, as a starting point, not to trust civil society, NGOs, not to consider that they would have the same level of expertise as a finance professional or someone working in the industry. So in order to be credible, in order to have to be listened to, we need that in-house technical expertise, and we rely on it to give us access and credibility with policymakers. In Brussels, some of you might know a little bit how it works and how lobbying works, but it's very transactional a lot of the time. So you offer your expertise or information in exchange for access to the policy-making process, in order for access to contribute or to FaceTime to politicians in order to convince them of different points. So it's not purely transactional. You have to convince people. You have to bring good arguments, the right messages, speak to people at the right time. And something that probably is missing at times from civil society campaigning is making sure that you ask a policymaker, a politician, for something that they can give. So there's no point going to a politician or a policymaker who's working on financial regulation and asking them for a carbon tax. They would consider it economic policy, different ministry, different minister at times, or different department. So knowing who you're talking to and what they can give is really important. Being in Brussels is also important because it's its own little world, and a lot of people arrive in Brussels very early in their career, do an internship at the European Commission with 200 or so other people, maybe get to know 20 or 30 of them really well. Some of those people go into similar jobs, stay in the Commission, or they meet people through the second or third job that they have. These people might then have access to a bit of information or a document that you might want or need as part of your work, which will then get shared through the network of people who know each other. And given that some people or many people are doing that, you need to have some access to that similar set of information to keep up, to be up to speed with what's happening, to follow debates and be able to and be relevant in the legislative process. So as a small NGO, we do, as I said, need to try and amplify our impact, so try to punch above our weight. That often means trying to work with members, so as our closest allies, so trying to increase our capacity, basically, have other experts that we can rely on that cover topic areas that we don't necessarily follow as closely, but also using them to reach out to national ministries or somewhere where we don't have a representation or close proximity. We'll get into a little bit of financial regulation in Brussels for those who are not so familiar with it. But what you'll come to see is also, and what you may know already, is that member state governments and finance ministries are incredibly powerful. They hold the most power in the legislative process, they hold the most weight, and they're increasingly using it to drive the agenda in Brussels. So one of the other things that we do, which is linked to having credibility in the policy process and ensuring that we can have access to policymakers and the information on the legislative process, is being members of expert groups. So we are members of expert groups of the European supervisory authorities, so that's the collections of financial regulators for insurance, banking, and the financial markets. EIOPA, ESMA, and EBA, Banking Authority, and European Insurance Authority. We're members of those groups. We chair one of them. We're vice chair of another one. And we use those groups to get access to the level 2 part of the process. So the second layer of implementing regulation in the EU, 3 layers. Level 1, the base regulation that's approved. Level 2, the standards that implement that regulation. And level 3, guidelines on specifically how to implement it. And also membership of expert groups in the Commission, which help us at that very first early level of policy creation. It gives us expertise and access to the policymakers. In addition to our members, what a lot of NGOs and civil society organizations do in Brussels is work together in coalitions and partnerships. That's mostly formed around topic areas. So sustainable finance at the moment has been a huge topic area. A lot of coalitions operating on either specific files, targeting them, trying to share intelligence, information, and also extend their reach. We do also use the media as much as we can, although what we found and what we see over the years is that what happens in Brussels has very limited visibility. It has visibility in the Brussels bubble to policymakers, maybe to a few interested people, but really doesn't hit people at national level, doesn't often hit the national press in many countries or get the same uptake as as news on national political issues, on what's happening in global politics elsewhere. EU regulation is a bit of a niche Brussels bubble topic. That being said, you can still use the media and in that small bubble to increase pressure, to give visibility to your arguments, and hopefully create public pressure through doing so. And the same is true of social media. I think I've been through most of what I said here on national politics already, but I think maybe one thing to mention is that we use national networks. So we try to organize at national level where we have good representation, in France and Germany in particular. And there we have national networks of NGOs that regularly meet to share expertise. We produce materials in their language to also help translate some of the messaging for the countries where there's the most kind of active members, Italy as well. So if anyone does have questions, there's time in a little while, so I'm going to steam on through these topics if that's okay for everyone and go straight into decision making. Probably familiar for most of you, the actors that we target in our advocacy and our lobbying work, but also those who sort of are on the peripheries of it, who are around it. Our biggest kind of counterparts really are the industry. So the industry is often calling for less regulation or deregulation, and we're often finding ourselves fighting against their positions because we don't believe that what they're asking for is in the public interest. Think tanks typically have a different role in Brussels, so more hosting debates, providing a forum, but it's worth noting that many think tanks also have paid partnerships for events, etc. So in Brussels, it's always worth kind of double checking where the content's coming from, who's paying for it, because a lot of consultancies are also funded by the industry, host events, and a lot of organizations sort of posing as policymakers. Even news outlets like Euractiv, although mostly now they will indicate their sponsorship, will post articles that can be paid for by the industry. So it's just worth mentioning that there's many different ways to influence the narrative, including just directly paying an organization to put messaging and articles out there. So there's a very heavy slide here, which perhaps you can take time to look at if you want to after the presentation. It's just to give an idea of what we really mean by advocacy and lobbying. What do we really do around the legislative process, and why do we do it? So I'll spend a little time just going through it and explaining what this all means. This is a specific tube map which kind of reflects financial regulation in particular because of the end of the tube map, where we go into level 2 guidelines through the European supervisory authorities. So that might not always be the same in EU regulation. So probably the first rule which we always would apply for advocacy and advocacy campaigns is that the earlier you can start to try and influence, the more impact you're likely to have. If you can influence the questions on the Commission's consultation when they're starting to build ideas on what a legislative proposal could look like, well then you're already starting to have access and influence on the way the thinking's done, the framing, the guardrails around what's going to be done. So you have you can potentially have a lot more influence than if you're coming in at the end when a piece of regulation's already been written, or the proposals and the amendments have been written, and you're trying to unpick them, change them. It's always going to be so much harder. So we always try to be involved at the very start of the process. That's partly through the expert groups, which are often consulted at the very start of the legislative process, even before a public consultation is released, but also through the process of internal drafting in the Commission. So this is a process of trying to understand who exactly in the Commission, which official in that department is going to be doing the writing, trying to be in contact with them, trying to spend time with them to convince them of the key points that you think need to be put across that are in the public interest from our point of view. One of the other avenues that we sometimes try to use is also the expert groups with member states. So member states, not just us, have ways to influence at the very, very start of the process, and it's in the Commission's interest to understand if a piece of legislation is viable, if it will get through the ordinary legislative procedure. And here, one of the most relevant groups to us is the European Expert Group on Banking, Payments and Insurance, where member states have representatives from ministries or supervisory authorities who go to discuss implementation of regulation, but also upcoming regulatory proposals. So for the Commission to test the water, does this have a chance of getting through member states? What are their concerns early on? If you can influence the people who are going to these meetings, then you can already have some sway over how far the member states are going to go, some information on how likely they are to oppose or not, which member states are interested in favour or not, and building that picture of who's in favour, who's not, what the positions are is the start of your process. It's also quite a few different Excel sheets, as you can probably imagine, tracking positions, tracking member states, tracking contacts, tracking meetings. So yeah, no escape from those in our line of work either. Proposals for amendments are built on the research that we've done, on the positions that we've done. So typically in this process, a report that we write will come before the start of this process. We'll aim to have written a report and done our research before a legislative process starts, or before a review of a legislative process starts, which follows the same procedure. And then our proposals for amendments will already be drafted at an early stage, and we'll adapt them and the key messages depending on where that process goes, where we see opportunities arising as we get further down, further along the tube map here. So as you can kind of see from the tube map, the idea is that you try and take every opportunity you can. You target moments for media engagement or press releases, media alerts, to engage the press where there is something that could be newsworthy or considered newsworthy by the press in Brussels. So those are mostly votes, key moments when a position is solidified by a vote, because then the press can say, this is the Parliament's position, this is the final piece of legislation. But actually, through the process, after we've got our key messages and amendments done, the main piece of work through the core central bit of the tube map there and part of the process is just trying to use the context you have to gain intelligence. So where are we on the process? What are the behind the scenes discussions, non-public discussions, which are happening between members of the Council, between the different members of the European Parliament working on the file? What are they? Who is putting a counter argument against our amendments? Which group, which politician? What's the argument they're using? How can we feed back a counter argument? How can we feed back a paper, a piece of evidence which debunks it? So that's a lot of the work which happens through that process. But it's extremely important to have the information on what's happening, where those discussions are, to be able to do that debunking, to be able to counteract the different messages or obstacles that are coming up. We get to the end of the process, the hardest part of the process to lobby. If you haven't got your positions already into a text at this point, you can forget having any impact. That's the trilogues. So trilogues, when the two texts of the Parliament and the Council of the European Union come together with the Commission text, a lovely 4-column document with lots of text in it, and they work through this document, this huge table, article by article, recital by recital, line by line, and just negotiate which text are we taking, the text of one of the 3 institutions or a compromise wording between them. Ends up being hundreds of pages of documents. Back in the day, you used to see who was in trilogues in the Parliament, because you'd see people carrying these horrendous kind of piles of paper. No longer. It's mostly just online now, but still, at that part of the process, it's very, very difficult to actually have some influence, because discussions move fast. You have to have regular calls. Sometimes trilogues are weekly. The last trilogues often kind of creates pressure. Go in a final meeting which goes through the night, and what you'll find is just through the night, depending on the level of importance, people will kind of duck out until the least important people, by title, are left to actually do the work. That's often the way in Brussels. Probably shouldn't say that, but there we go. So after that, you get to your plenary vote, and we move through to the level 2. Why is it probably important to mention the level 2 in financial regulation? Well, because a dynamic has kind of been coming into play in financial regulation over the last 10 years or so, where instead of agreeing political priorities and positions through the level 1 text, through the regulation or directive itself, increasingly, where there aren't compromised positions between the Parliament, the Council, or different political groups, we're using level 2 measures to push the decision or kick the can down the road so that the ESAs, the European Supervisory Authorities, effectively take the decision or make a proposal for that area where there was no compromise. It started off probably as a tactic from the financial industry, from the lobby, to kind of, try where they couldn't get something into a level 1 text, have a second opportunity to lobby. And as that's become more and more lobbied and more kind of ingrained into the way business is done, it's become more and more common that you have areas where there's no compromise getting pushed to level 2, which means that the European supervisory authorities are also coming under way more scrutiny and being lobbied a lot more than they used to be. So it does change the dynamic, and it's a different kind of dynamic in regulation that we have now. Interestingly as well, now that that's happened, the industry is targeting them as well. And recently they've been calling for, and you'll see the French government has also been calling for that, calling for more restrictions on the powers of the supervisory authorities at this point. So it's an area where member states and the industry can very easily align. Member states, because their national competent authorities want to keep power. That's the message transmitted through to the finance ministries. It also allows these competent authorities, let's say, what's happening behind that kind of veil of, well, keeping sovereignty is also keeping the possibility to allow a little bit more advantage for your national industry, for your French banks versus the Spanish banks, whatever it might be, slightly different application of the rules that would benefit them. So it's allowing that flexibility, that competitive advantage. Unfortunately, Europe and the EU isn't so much about collaborating together as competing at the margins, especially when it comes to making regulation and finding compromises. So a long slide, a full tube map, but hopefully interesting and helpful just to understand a little bit how we actually lobby, what it means when we talk about lobbying the legislative process. So we already mentioned them, or I already mentioned them, the supervisors, the standard setters. So they are incredibly important in our work on financial regulation, particularly when it comes to banking, because the post-crisis banking framework has been negotiated with central bankers and national competent authorities at international level through the Basel Committee. And that continues to be where banking regulation and a lot of the discussions on how to regulate banks happens. One important thing to mention at the moment is that the latest iteration of the Basel framework of the prudential rules for banks is being challenged. So we'll talk about it a little bit later on, but there's a new agenda for competitiveness, being competitive globally, having a competitive global banking industry. This agenda has filtered through, and President Trump, Prime Minister of the UK, have also, Keir Starmer, have also put this into question. So they've questioned whether or not they will fully implement this internationally agreed framework for financial stability for banks. Now what's translating through is that the European Commission, under pressure from the financial industry, is also putting into question if it will fully implement this financial stability framework. So a new dynamic, and we'll talk about it a little bit later on, a new dynamic starting to come in from what was a very clear political process and supervisory process where we had leaders post-crisis calling for financial reforms, those reforms being worked on by central banks and governors, and national competent authorities, filtering down into legislative processes based on the recommendations and frameworks they created and being implemented into EU law or other law. That's now being challenged, and that process is being challenged. So you have a disconnect between the leaders of the G20, for example, who still mandate the Financial Stability Board, the Basel Committee, the International Association of Insurance Supervisors to work to protect financial stability, but where they are undermining the process when they are as individual members of the G20 and it comes to implementing what they've asked for in their jurisdictions, in their legislation. So one of the important organizations to bring up for later in the presentation when we talk a little bit more on climate risk is the Network for Greening the Financial System, which has been set up as part of the sustainable finance, but more specifically the climate risk part of that agenda. So it's an organization where all of the other organizations on the slide are part of it, national competent authorities themselves are part of it, and where work is progressing on how to try and measure climate risk in particular. So trying to use mostly traditional risk management techniques and see how they might need to be either updated or used when it comes to measuring climate risk. And that's, by climate risk, I mean the risk to financial stability from from climate change and the climate emergency. So, at Finance Watch, we split our work into 5 key areas. So 2 of them probably cover people, but anyway, digitalization, sustainable finance, retail inclusion, public finance, and stability and supervision. So digitalization in reality as a topic probably splits in half and is covered by 2 of the other areas, stability and supervision. So when we really look at how digital tools or companies might put financial stability at risk. So an example of that might be when the Googles, Amazons of this world want to compete in financial markets, want to offer financial products, but may have more capacity for monopoly, may have capacity to bypass existing financial rules, authorizations, etc. So a stability risk. And then also really when it comes to retail users and the possibility of excluding people from accessing the financial services they would need to participate fully and equally in society. And there you're really looking at how data is used by financial companies, how privacy is protected. Sustainable finance, the area we'll kind of touch today, a part of that area. So the EU has worked on sustainable finance for many years now. It's had an action plan followed by pieces of legislation to try and give more transparency over how sustainable companies are and how sustainable investments are, but also with the specific aim, at least until recently, of directing investment towards a safe, sustainable transition, a transition to a sustainable economy. Sustainable, to be debated a bit now, what's meant by that in the current climate. Retail inclusion, as I said, focuses on access to financial products, so making sure that people have the products they need, but also specifically looks at the issue of over-indebtedness. So when people have sort of got themselves into a level of debt that they can't get out of, looking at insolvency proceedings, personal insolvency or consumer insolvency, which is sort of a grey area or a hole in the EU regulation at the minute. It's optional for member states to apply. Then public finance. So it's an area of work that we've worked on in the past. We work on a little bit less at the moment as Finance Watch, but where essentially we're looking to say, do the rules that we currently have in place at EU level, do they really allow member state governments to invest where they need to? And our response so far has been no, not really. The levels or the restrictions put on public investment are arbitrary, not really based or justified, and therefore would need to be changed. Stability and supervision is really the core of the business that Finance Watch was set up to do. So looking at how to safeguard European citizens and taxpayers and ensure that we don't have to bear the cost if there's a financial crisis. So a couple of the things on the slide now I mentioned already, looking at the current kind of regulatory outlook, looking at the different themes that we're tackling as we look forward for the next EU mandate. So in Brussels at the moment, we are continually seeing the mention of competitiveness. It's a strong pushback from a lot of what we see on the wave of regulation that happened since the financial crisis, saying that we've undermined the competitiveness of companies by over-regulating. A lot of narrative framing has been happening from the financial industry for a number of years now. Regulatory overload, tsunami of regulation, overload of documentation, too many pages, very burdensome, administrative burden, all these terms that have been introduced to kind of cast doubt over whether or not those pages are actually valuable or have a value, but rather put forward a narrative and agenda that they're undermining the competitiveness of the industry compared to industries based in other jurisdictions where the regulatory burden is lower or they have less requirements. Finance Watch's point of view here, as you'll see probably as we get through the slides, is that we've put regulation in place for a reason. We've put it in place to put limits on the way that financial industry can act, and we've put it in place to protect society. So there may be cases for being more efficient. There may be cases for reviewing regulatory frameworks to make sure that they perform as well as they do, that they work as well as they should. But for the most part, when the industry is coming with requests to deregulate to simplify, but you'll see the word simplification being referred to a lot, but effectively to deregulate is what they're saying. There's very little justification or evidence behind what they're saying. There's few counts, maybe page counts, but not counts of or evidence as to why requirements are not actually working, or any numbers put on the cost of administrative burden. So the focus of this agenda has also been around 3 reports that you will have probably heard of, or might have heard of, the Lettre, Draghi and Noyer reports. They are particularly important for financial services and stability because they've called for competitiveness, or they've coined the term competitiveness to deregulate, or allowed this idea that deregulation could be a way to be competitive. It's an idea that was also introduced in the UK under the last government, who changed the mandate of the Prudential Regulatory Authority to have competitiveness as part of its mandate, which is now one of the knock-on effects and asks for the European supervisory authorities in these reports and from some of the political groups. When we look at sustainable finance and climate risk, we see that there's already a very concrete and heavy pushback. This was already the case under the previous mandate. What we saw is that the centre-right groups joined with the far-right groups, so kind of broke the traditional cordon sanitaire, where we don't work with the far-right groups, or the centrist groups don't work with far-right groups. That's been out the window when it comes to financial regulation for a very long time now. And these groups have been working together in particular to undermine the EU sustainable finance agenda. So to push back on rules for transition plans, to push back on rules for more transparency over how sustainable investments are. And that's now coming to a head and kind of going on a turbocharged agenda to push back against the sustainable finance agenda now, supported most recently by the French government, but also many others, which is to call for the regulatory burden that sustainable finance requirements bring in, so-called regulatory burden, to be reduced through an omnibus proposal. Omnibus proposal is just a term used in the EU when you gather several different pieces of legislation into one legislative proposal, so amendments to several pieces together. So it would amend several bits of sustainable finance regulation to reduce the reporting requirements, to reduce the disclosure requirements for financial companies and other companies. One of the key issues that we see is that part of this agenda, part of the push from the financial industry, is also about a false sense of security or a lack of recognition of the scale of climate change and the risks that it poses. So we'll get into that a little bit later on when we look at assessing climate risk as part of the presentation, but effectively, if you use traditional risk mitigation techniques or risk management techniques, you have a different horizon, you have a different way of looking at climate risk. You use historical data, you rely a lot on historical data for your modeling, and also you rely on assumptions which give you the sense that the impacts of climate change will not be as great as we know climate scientists are outlining and have studied. So this imbalance often gives policymakers, is what we're seeing in Brussels, policymakers a false sense of security. They look at the work of the NGFS that we just mentioned earlier. They look at the work of central banks. They see different scenarios, and the names of the scenarios even will give a misrepresentation of the reality, because you'll have an extreme scenario, which might actually be very close to what we would call the hothouse world, the name of one of the reports that we're referring to in this presentation as well. But a hothouse world, so a world 3 degrees plus where we start to see, 3-4 degrees plus, where we start to see that economic activity is at risk, that the risk of disruption to the economy is extremely high, but which isn't really recognized. It's considered extreme rather than the pathway that we're actually on, which is more close to reality. So one of the other challenges that's coming up, as I just mentioned as well, is the fact that the US and some of the EU elections that are pending this year are also having an impact on the level of regulatory ambition and bring into question whether or not financial stability frameworks will be adhered to and whether or not we'll be able to progress in the work that's been set out that we need to do to capture climate risk or other financial stability risks that have been emerging. Another key challenge ahead through digitalization and the adoption of AI in particular, it's one of the other key topic areas that's on the agenda in Brussels at the moment. Depending on who you talk to, the solution for everything or a huge risk, the adoption of artificial intelligence and what it might mean for consumers, for the level of intrusion into their lives, their data, and the processing of it, but also the control you have and the visibility you have over how financial products are being distributed, how people are being profiled, and even how internal models, so the models that financial institutions use to calculate how many capital requirements they have, even those as well, to see if you actually have a clear view on how that's been done. Okay, so maybe getting a little bit more into the details of each of these topic areas. Stopping for a quick time check. Yeah, getting a little bit more into the details of these topic areas, but maybe quickly so that we can get onto climate risk as well. We see that the public interest will very much be in pushing back, or at least explaining why the financial reforms that we've been calling for are needed. So why we shouldn't be deregulating and why we need to maintain ambition. We've been calling for that ambition to be in place and to go further, because we still don't think we've reached the point in financial regulation and particularly stability regulation that we said we would after the financial crisis that was estimated to be needed by experts at the time. Yeah. So when we look at financial stability specifically, we're talking about finalizing the Basel reforms and fully implementing them, something that's at risk from the UK and the US at the moment. We also, rather than what the financial industry has been saying and some of the member states of the EU have been saying, we see the need to strengthen the European supervisors. We've seen that from smaller failures of insurers, even recently, but also smaller financial industry companies. So smaller companies that have failed and where supervisors in some parts of Europe are much weaker. And have much less of a view, but where the impacts can potentially have knock-on effects. The strength of these European supervisors is incredibly important for that, but also to bring together a wider view, a macro view of what's happening, of trends, of where risk might be, and act as platforms to both regulate and also share information, supervisory information, collect and share for that broader analysis, for that independent perspective. They don't have the resources to do that properly at the moment, but they also still rely on the dynamic as well of their boards, which, I mean, it's a little bit the turkeys won't vote for Christmas, in the sense that if one of the big powerful member states were to have an issue, it's very difficult for the supervisory authorities to move forward with it, because they have a board made of the member state authorities. So it's a difficult dynamic. Perhaps jumping on to sustainable finance, we'll come to the details of that in the last part of the presentation on climate risk. But one of the key proposals that we've had from the start of this agenda has been to say that in financial regulation, in stability regulation in particular, when you don't have a proper way to calculate a risk, you should take a precautionary approach. This is very much the way that regulation has moved on crypto assets, for example. So saying that because we see that they're risky, but we can't necessarily quantify exactly how risky, how the market's going to move, how they're going to be, we'll take a precautionary approach and will ensure that financial institutions have enough of a cushion, a financial cushion, so they can access enough liquidity or financing if they need to cover a loss, a large loss, should something go wrong linked to these kinds of products or investments in these kinds of assets. The same logic would be true, in our point of view, for fossil fuel assets. We see them now as increasingly risky assets because of both the political agenda, but also because of what investing in them means. We'll get a little bit more into that as we get further into the presentation. But broadly speaking, the sustainable finance agenda, as I mentioned earlier, is in two parts. The core of it is really the rules for sustainable financial products, so categorizing what is a sustainable activity or not. Could I give you an example of how that played out, and also maybe to break kind of any impressions you might have that everything is based on incredible expertise and nothing would ever go wrong in an expert group in Brussels. We had a colleague who was working in the expert group who was making proposals for thresholds for categories, happened to be an expert also in chemicals, made a proposal. The threshold was set first 50% lower, just because the industry was also in the group and said it was more appropriate. No evidence, so we came evidence-based proposal. Here's a threshold with evidence. Industry said no. So just to say that this has been a very difficult debate, very heavily lobbied. And why? Because we're coming with this whole sustainable finance agenda to the very touchy topic of cost. So some of the measures that we're bringing in, and often that is what it comes down to, but here it's very transparent, very clearly the case. When we're talking about amending legislation at times, there's cost. Sometimes that's just administrative cost and burden. Sometimes it's more. And when it comes to the sustainable finance agenda, we're talking about how is the transition financed and who will bear the cost. And this is also, I'd say, the threat or if not threat, the reality that's being presented by financial companies is that consumers will pay for the transition, both as taxpayers and as consumers, because any cost they have to assume they will pass directly on to their consumers. They won't allow it to affect their profit margins. So it's worth bearing in mind because it is a dynamic that drives this agenda and why it's being reduced, why there's a push to reduce the number of requirements. It's also an interesting way to look at lobbying in Brussels and industry associations, because very often for them, if you look at the administrative cost of a new measure, it can probably be quantified for large companies. Say for the banking industry, a new piece of regulation, a new information requirement costs a medium to large size bank €1 million in the first year, maybe year two a bit less, they can amortize the cost a little bit. If you can then make that calculation and see if you're paying collectively 1 million with most of the other banks in Europe for a lobby organization in Brussels, it's way cheaper than having to have new regulation. You can just finance these lobbyists, they'll reduce the cost for you. Perfect. For an NGO, much more difficult. We're trying to convince people to serve society and that we need a financial system to serve society, not really trying to calculate what that would mean in monetary terms, but in terms of what the proposals deliver for society. So much harder to kind of quantify, and that's one of the things that we try to do, but it's much more difficult. So quickly touching on retail finance and financial inclusion, it's one of the topic areas that probably can be more quickly understood and is much closer to our everyday lives and realities, because it's about the financial products that we need and use to be effectively included in society. We need a certain set of products, most of us in most EU countries. That includes things like a bank account, fundamental most of the time if you want to legitimately rent an apartment, if you want to be paid a salary. Also other things like perhaps a savings product, a pension product in some countries, health insurance. If you need a car, you live somewhere where you need a car still, car insurance. And so what we're looking at in this topic area to be financially included, so to have the products you need to participate fully in society, is which products would those be and what sort of criteria would you need to have for them. And it's already something which has been introduced in EU regulation in the European Pillar of Social Rights, so a set of aims that the Commission has, and their access to financial products that people need is one of them. And within that, there's already a proposal for a pension product which wasn't successful for a European pensions product, which would have a basic option. So an option which was simple, safe, and suitable for any consumer. So it doesn't have to be the product that you would have, but it's an offer that could be safe for anyone, could be suitable for anyone, and that could be accessible for everyone. The other part, as I mentioned before, was over-indebtedness, so trying to reduce over-indebtedness. It's something that we saw spiraling during austerity, but also during COVID in particular, where people got into arrears on their mortgages, either because their furlough scheme payments weren't coming through, or because they were losing their jobs or their salaries were on hold and getting into arrears. And here, one of the key themes or topics there would be a forbearance, so being able to defer payments or come to agreements to get out of your over-indebtedness to be insolvent, a concept which is more developed in the US than in Europe, which still holds a lot of stigma around insolvency, but to ensure that people don't sort of get targeted by debt collectors, a very low-regulated industry in the EU, where effectively in many countries, debt collectors can use very questionable tactics to try to extract money, as much money as they can from people of what's outstanding on their loans, but actually push them into situations which would mean they're living outside of their human rights, effectively, not a life of dignity, or not with the minimum amount of money that they need to kind of just live a basic life. Digital, I think we've covered already, broadly speaking, what is there. One of the things we're working on, and one of the big fights in Brussels, is over the digital euro, and whether or not a digital euro is needed, what it would look like, what it would be for. As you might imagine, payment companies are questioning the need for it and asking for the control over it. So this is an ongoing debate in Brussels. Public finance, I mentioned already a little bit, but it's really questioning, and it came into focus, I would say, during the post-COVID period, where we had started to question whether or not we would allow more EU investment capacity for the climate transition, for the recovery, but also the climate transition, which kind of opened the space in Brussels to talk about if we have the investment we need, and what's the role of public financing in the transition compared to private financing, which is what we talked about mostly up until then. Okay, we're getting there. It's a warm room and a lot of talking, so thank you for bearing with me. Okay, this is the kind of zoom in now on climate risk. So looking a little bit at why we work a lot on this topic and why it's so important to us. It crosses over between financial regulation and kind of and the sustainable finance agenda topic. What this infographic is trying to show you, with probably too small writing and a lot of pictures, is the concept of double materiality to some extent, and also how that kind of, we think that should be taken into consideration in financial stability regulation, so in prudential regulation. What we're seeing is that, what we see and what the concept of double materiality is about the two impacts that are had from climate change on financial institutions. So on the one hand, their support, their lending, their investment in the fossil fuel industry, assets, loans, etc. So the fact that they're continuing to finance that activity, even the expansion of that activity in many cases, what that means for the accumulation of financial risk, so how much more difficult or urgent that makes the need for transition, how much more severe that makes the physical damage, so the losses that are incurred from weather events linked to climate change, the impact on cost on those organizations, so particularly would come to mind insurers, but also the banks who've had loans, mortgages to businesses that then lost their business or whatever it might be, the damage that's there, and how that will then hit back the financial companies, hit back their investments elsewhere, which devalue. And also within this dynamic, very important, and it's kind of the core of a lot of the work that's happened in Brussels, is the discussion of transition and transition risk. So the risk of stranding, which many of you may have heard of, but really when we talk about fossil fuel financing, the idea that some assets, some business categories will not be compatible with a transition to a sustainable economy. So if we transition to a sustainable economy, or if we manage to, certain categories of assets, certain business types will need to, will either devalue completely, will either become obsolete, or will change their business models and their activity. And here at the moment we have a big debate in Brussels over whether or not we should have a new category of financing rather than saying sustainable financing, green and brown, unsustainable activity. We should have the transition financing category, which would be the activities that are brown but need to transition to green or should or could transition to green. And this is what member state governments would like, because then they can put a nice sustainable label over a lot of activities which aren't sustainable, saying that they're transitioning. So unfortunately, that's probably what's happening. So a number of points on climate risk in particular which are really important. Some of them I've mentioned already, but some of them we can look into in a little bit more detail here. In particular, maybe zooming in a little bit on how we try to calculate the impact of climate risk and how we try to bring it into risk management. So traditionally, what we'll try and do is use economic modeling based on historic data to understand and calculate what might be future losses, future impacts. And we'll work back from there to say, well, you need to be prepared, so you need a financial cushion of this much money in case those losses occur. With climate change, pretty difficult to do because we see exponential changes. We see that there are impacts from things like tipping points, so when certain biodiversity systems, when certain parts of the climate have been impacted irreversibly or have been impacted and have knock-on effects which are very hard to predict and calculate. And therefore meaning that that historic data, even the trends that we see now, unfortunately probably not going to be representative, or we know they're not going to be representative because we have climate scientists spending all their time looking at this, calculating what could happen, what are the issues, and we know that that's going to be a fundamental issue. So seeing the limitations that traditional economic models have when it comes to trying to calculate the losses from climate risk. Very difficult for actuaries, risk managers in the financial industry to accept, and very difficult as well in a world where climate change is being heavily politicized for central bankers and financial regulators to work within this space, because as they're trying to understand the limits of economic modeling, trying to understand how to capture the cost of climate risk, they also are trying not to get involved in the political debates over what economic policy should change, whether or not a transition should happen and how it should transition, which is highly political, or has been highly politicized. And so it puts them in a difficult space where they want to try and rely on what they know, historic data, economic modeling, giving us conclusions on predicted losses and setting our capital requirements. Another flaw in financial regulation, so in stability regulation, prudential rules in particular, is the short-termism. So they're designed to capture the situation of a financial institution for the next year, and try to calculate what would happen in terms of potential losses from all the different investments, assets, impacts from things that you need to calculate and could impact your business. What could the impacts be with a short-term horizon, typically 1 year looking forward, but also then maybe looking 5, maybe 10 years max forward in terms of where is your business going, making some predictions, setting some goals, explaining a little bit what your business model would be and where you're aiming to go, but not really going into the details of calculating what that would mean or seeing how that would match up with climate risk. And this is particularly important when you look at the goals of the Paris process. So looking to be things like carbon neutral by 2050 and seeing how that will match up. Why? Because it doesn't just speak to the change of the climate when it comes to calculating risk, but it also brings into question things like litigation risk. So how far are these targets bound into law? In the EU, in theory, they're bound into law, that we'll meet these targets and that all EU laws should implement these targets that we have as part of the Paris process. But what we see now is that there's a risk of deviation. So most of the pathways that companies are on, or many of the pathways that companies are on, would not be aligned with where we're going, or with the final goal of the Paris process. There would be some delay, there would be sudden adjustments needed at the last minute or at some point in order to get back on track and have targets that are aligned with that. So making investments in industries that are aligned with a net zero economy, etc. And that deviation risk, if it is another example of a risk which could be, or isn't yet being taken into account. And it's very much around the mechanisms of the transition and the political risk linked to that. So will politicians implement a transition? And if they don't implement a transition, will the physical risks become so great or accelerate to the point where there's a disruption to the economy, which in turn has an impact on financial institutions? So looking at deviation risk, disruption risk, in addition to our kind of classic risks of physical impacts of climate change. So this would be the sort of forward-looking perspective that we're talking about, trying to have a precautionary approach. It's a principle that's used elsewhere in regulation already, but which we think would have a very clear, concrete application in the case of climate risk. So and sort of allow us to bring in a qualitative and quantitative, a combined approach in order to be able to give ourselves some conclusions, but also protect ourselves from the lack of data and knowledge that we have about how far this problem is advancing and what the impacts will be. There's some concrete processes that are going on right now in Brussels. The financial stability rules for banks and insurers have been reviewed over the last 4 or 5 years. We've been closely following that work as Finance Watch, and we've been calling for a very specific policy proposal to be introduced, and that's the increase in the capital charges for fossil fuels. What we've said is that new investments in fossil fuels, so any expansion activities or new extraction activities, are effectively a guaranteed stranded asset, at least if we're planning to implement the laws and targets we have for to be Paris compatible. So effectively, that is extremely high risk as an investment, because the risk of stranding is effectively 100%. It shouldn't be extracted. At some point, if we move down our pathway to transition, if we do what we say we're going to do, the risk that you'll lose that investment is effectively 100%. And there we had a proposal which was kind of explained as the one-for-one proposal. So effectively, for every euro you would invest in fossil fuels, you would have to have a euro available in a capital requirement, the one-for-one proposal. Hopefully it's understandable. I think it probably is. You guys probably know enough, but if not, do ask questions on it later. Capital requirements are politicized in Brussels a lot because it's said that the capital is being held and it could be invested in something else. When you talk about capital requirements for different things, this is a bit of a fallacy because it's about risk pricing. It's a concept which is part of prudential regulation. It's about making sure that you price a risk correctly and that you have the capacity to bear the losses that are commensurate with that risk. It's a core concept to the work that we do here, but it's also part of the concept which is being challenged by the financial industry at the moment in the competitiveness agenda and in the kind of as a carrot to dangle to policymakers to say, we have all this money which could be invested. There is a cost, and the cost is the risk to society in case there are financial losses for that company, in case something goes wrong. So it's worth bearing that in mind whenever you hear these kind of challenges and the fact that there's this capital being held onto. It's there as a cushion, and it's not necessarily anyway just money that's held onto. It's types of assets that need to be invested in. So it's worth challenging and it's worth questioning. Very good news in our perspective is that at the end of last year, the European Insurance and Occupational Pensions Authority recognized the proposals. In the sense that they did an assessment of the impact of fossil fuel investments, tried to use forward-looking methodologies and perspectives, not perfect ones, but tried to look at what that would mean for insurers and whether or not these assets could be riskier, underpriced than they are at the moment. And they've made a recommendation to adjust to increase the capital requirements for fossil fuels for insurers, which we're now calling for the Commission to swiftly implement. And we're also calling for the European Banking Authority to make a similar recommendation. But here, the competition at international level is makes this much more difficult politically. I'm not one to question whether or not the EBA or banks have more influence or not over them, but they aren't at the moment putting forward the same recommendation. But we do know that there's a lot more talk of competitiveness when it comes to the banking industry and the level of regulation, especially versus US banks. And in the current climate, it looks unlikely that that will move forward, at least for banks. We'll have to see. So maybe just to finish on the international agenda, and slightly over time, so sorry for that. But just to wrap up now, on the international agenda, we're looking at the committees both on banking and insurance that collect together the supervisors. And here we're looking effectively to recognize similar proposals in their standards. And that's discussions which filter through. It gives you an idea of the connection of all of this. NGFS, run by the Banque de France. Banque de France represented both in the Basel Committee and in the ECB, as well as in the IAIS. So links of organizations which hold power, which are sort of represented through all these different bodies, cooperate with the French ministry, drive EU rules or limit them, and ambition accordingly. So it's always worth remembering that there are certain actors who kind of have a lot of say, a lot of sway, also from the competent authorities. Okay, there's two slides here which maybe can just be for reference. They're just a little bit of the timelines at EU and international level, so you guys could track the processes, the regulation that's upcoming. I don't think we need to get into the details now, but happy to look at them later if you'd like. So we've got one for EU, one for international. And I've also included a set of references of some of our publications which cover the different policy measures we've researched and proposed for climate risk, for sustainable finance that could be relevant, and also a couple from our partners which are core to the work we do. And so with that, thank you.